Welcome back to Real Deal Investing. I'm Larry Mastropieri, real estate broker here locally, and joined with my co-host Jerron Kelley, who's a attorney here locally as well, real estate attorney. And our guest today is David Purisch. And David, go ahead, tell them your company's name and your thing.
With Horvath and Treadley Capital, we started a debt division with that commercial real estate office about 10 months ago.
Awesome. And you're a commercial real estate broker.
I am.
The good news is both Larry and I have worked with you for some years now. You're awesome. Back when you were with Marcus Millichap.
Correct.
Worked together for years with a lot of mutual clients. I know Larry has worked with you personally. You placed a loan with him a few years ago.
You took me under your wing.
Yeah.
I did.
When he was a novice investor.
Well, not only novice, he was still a chemical engineer.
That's
not
right.
even really. You weren't even in the real estate business.
His hobby was real estate with his business partner.
That's right.
Boy.
He hadn't made the full commitment yet.
Okay.
Yeah.
He was green. Yeah.
The deal we did together, that you lent on, I remember vividly because I didn't have a car at the time because I was transitioning at that exact moment from being an engineer to the
Transitioning careers, right? Okay. I just have to make sure nowadays. It's 2025. So yeah. Okay.
Yes, transitioning careers
Got
to
it.
being a full-time real estate investor / broker, and I was working for GE before, and they took my car away from me because that's what they gave me when I started working for them.
The company car.
So I was driving around. I think I showed up to the purchase on like a motorcycle or whatever I had at the time. And
had to steal a car to get
it
there
looked
to the
like a ridiculous buying a $1.2 million multifamily building. But you didn't let that shake you. You still gave me the loan.
Your first client that bought an over $1 million property without a car.
Yeah, there you go.
Yeah, cool. Well, you're breaking records, Larry, as always. No, cool. Yeah.
Yeah, so we have some history.
Yes, we go back a long way. So and I've been doing this as a lender initially back in the early 2000s. I was a nationwide small balance commercial lender. I learned the business that way. Actually, my background, all my education is in psychology and counseling, and I did that for about a dozen years.
Okay.
Oh, wow.
And was raising a family and trying to figure out how to make ends meet.
Okay.
And at that time, figured a guy I play basketball with. I said, "What do you do, and do you like it?" And he said, "I'm a commercial real estate lending. I'm excited to go to work every day."
Wow.
When I heard something like that, I said, let me check this out. And my wife allowed me to take a pay cut to go into this business and learn it. And I was a lender until the crisis in 2010, 11, and then got into the brokerage side.
Okay. Can you explain the difference for people who have never worked on commercial loans? Two differences. One, what's the difference between if they go to a lender, Wells Fargo or Chase, and they ask for a commercial loan? What's the difference between going to a loan officer at that bank and signing up for a loan there versus going with you? What are the advantages of going with you? And then I guess the second part of the question, just to differentiate for people who've never done investments before, what is the difference between commercial loans and residential loans? So you can explain that.
Well, let's start with the second question first. So
Great.
Residential loans can be done on any property that is 1 to 4 residential units. If you add a commercial component, like it's one apartment and a grocery store or a hardware store, whatever, ground floor is retail, as long as it's not residential, it's considered commercial. But up to 4 residential units, a single family, duplex, triplex, quad, are all residential. However,
and people can go to a conventional bank for that, or a lender like Choice Mortgage or whoever it is.
FHA mortgage.
Get a conventional loan.
Correct. Conventional loan. Depending whether you live there or not, there's some things that come into play. But if it's your homestead, but for the most part now, if it's not your homestead and you're closing in an LLC, 4 units can be done commercially by some lenders. Also, at times people have side-by-side quads, let's say, that would be considered 8 units. That would be done commercially if they wanted to,
So
but
they can
have
put
the option.
the two properties
Correct.
together. They combine them portfolios, so the contract would be for the 2 parcels, and you do a commercial loan on the 8 units.
Or if they've collected a portfolio of single family, duplexes, quads, and we're doing 10, 12 units as one loan, a lot of lenders do that commercially, even though individually they're residential.
Awesome.
So that's the ability to do both commercial and residential. The difference in the loans is most residential loans are done what's called debt to income. They're looking at you, the individual, as the qualifier for that loan, where when you have a income producing property, they're focusing mainly on the asset and how the asset's going to repay the bill. We'll get in more into the debt service and other things and how that is underwritten later during the conversation.
Great. And can you also talk about now what are the advantages of using a mortgage broker like yourself versus someone going straight to, let's say, again, Chase, Citi, Wells Fargo, whoever it is? Yeah.
So on that side, when I was a lender, I had my program. And commercial programs are a lot different than residential programs. Residential programs are very regulated, and they are very standardized, no matter who you're going to. And that broker may be able to steer you in the right direction based on certain qualifications that you may have. However, they're pretty standardized. Commercial is very different. Let's start first with, there's a good swath of banks that won't do any commercial loan under $10 million. Then another one group that won't do anything under $5 or $3 million. So if you have $1.5 million loan, your population of lenders has shrunk.
And there's also some that don't do loans over a certain amount, like credit unions, right? They may limit themselves to $5 million loans.
That's a regulatory, meaning that depends on how much money they have in their assets. They are given a loan limit both to a deal specific and then to an individual in general. So it may be up to $5 million per deal, but capping at $10 million. But they can do participation and other things where they can get bigger. But yeah, they do have some limits. So as a commercial lender, you have your program. As a broker, I have everybody's programs. So if you're coming in and saying, I'm buying this deal, what's the best rates you can give me? I'll say between, like right now, I have a deal that just got the final commitment at 5.82%. I'll say so in the upper fives.
That's really good, by the way. That's an amazing rate to right now.
To the upper 12s, depending if you're doing hard money or whatever it may be. What's your story? What am I trying to accomplish with you? So to your question, if you go and call Wells Fargo and say, hey, I've got a commercial property I want to buy. Can somebody help me? Yes. And you'll get somebody who's a person there and you'll say, can you do this? Yes. Can you lend me 80%? Yes. Great. And you start the loan and then they get you a term sheet, and the term sheet has little asterisks all over, and it says, based on underwriting, must debt service to this, has all the specifics of how they're going to underwrite it. So that person that said yes is an order taker. What I do is I call the bank and I ask for the commercial loan officer. And that person, and I'll have the conversation, and I'll say to them, do you underwrite your own loans? I know the program allows you to go to 80%, but I've underwritten this loan myself, and I know it only carries enough cash flow to cover a loan of 65%. So if this person's telling me 80%, I said, let me speak to someone who knows what they're doing. So dialing for dollars in that regard takes time and effort. My partner and I often say that our inventory is the lenders because we spend a lot of time. In fact, following this, I have a lender meeting where they talk to us about what they can do, what they can't do, but that's the person that knows what they're doing.
Got it.
If you call your general bank, and sometimes I'll get a loan opportunity, like I have one right now in Pharr, Texas, which is by the Rio Grande Valley, which is by the Mexican border. And it's a strip center there. And I have some lenders that will lend in Texas, but Pharr is a very small town. So I went and called some local banks. And when I do that, I ask those questions. And for the most part, I get people that have no idea what they're doing. But they'll say yes because they want to try to get the business and they'll get credit for it, et cetera. But by the time it gets into underwriting, it falls apart. And at that point, the person spent 25, 30 days in getting documents in, gave them a deposit of $5,000 for third parties or $10,000. And now time, effort, and money's been spent, and the deal's going to crater.
Yeah, appraisals. And then sometimes you get to a point where you're at that financing contingency expiration and, you know, the bank's still saying yes, and you may blow through that, and then their deposit's at risk. So, yeah, that's a very dangerous position for a buyer to be in.
So you're looking around corners for your clients.
So when people come to me, what's the best rate, et cetera, my job isn't to get you the best rate and terms. I am going to try to tailor make rates and terms to make certain that it meets your business model. But my goal and my team's goal is that the loan gets closed. So I've told my processor, we're looking for any incongruencies in these deals. So anything you see that doesn't line up, we need to get ahead of it. Because something in every commercial deal, and I promise you, will come up. I don't know what it's going to be, but we're going to try to get ahead as many things as we can because my goal is not to put any of my clients' money at risk.
Yeah.
So what I found most valuable working with you, there's a lot of things, but to your point, like I can't know every local bank or regional bank that lends in our area. Some, we were just talking about this. Some don't lend in Palm Beach County. Some lend in Broward. Like you have the inside track on all that, and you can kind of quickly just point us to the answer and quickly tell us like, hey, we've worked with these guys a number of times. Yeah, they might say they can do this in 30 days, but maybe we need to think about this being a 45-day process, or just putting us in a loan that we can actually do. To your point, like, yeah. So
and again, it's easy enough to say yes, but if it's not going to work and you can't fulfill, then it has no value.
Yeah.
And my job is to provide value to the deal. And I tell my clients, I have one that I'm working with now. We're on our 4th deal since I've been with my new company. So under 10 months on our 4th deal, and I have an engagement agreement. So we'll go through all these things. I'll make sure that everybody understands, and I will, and maybe my counseling background does this, I spell things out and make sure everybody's on the same page, and we'll go through it and answer any questions. My engagement agreement basically says you're hiring me to do this. And I have a tail on there which says that you can't go back to that same lender. I introduce you to one lender. You can't go back to them right away with your next deal. And they said, why would I do that? It's now my new bank. Why would I have to use you? I said, you don't have to, but I'm just letting you know, go to any other lender. And I told them, because my goal is that you come to me for anything that you have and throw it at me. Say, David, what do you think of this? And I become your finance guy. Now, if your company's buying every year $300 million in real estate, you've got me in-house. But if you're someone that's buying their first deal or has 3 or 4 deals under their, you have either another job because you have enough portfolio to make a living, that's what you're growing to, or you are busy operating your portfolio. And when you have it, I'm your finance guy. You only pay me when you close. So you don't pay me a salary, you don't pay me, but you can utilize my time, my expertise as a consultant, and you may show me 8, 10 deals, and then that 11th deal, it's a go. It has legs, and we go to loan.
It's great. So, yeah, and you're not charging them on a per deal basis, right? If a deal goes south and it doesn't move forward to closing, they're not getting billed for that.
Correct.
So there might be, like you said, there might be multiple deals that you don't get paid on, and there's value for that time. But on the deal that does close, obviously you're providing that value because it did close. Which I want to say that we have a number of mutual clients, but I just want to give you credit and kudos. We're actually finishing off a deal here that we're closing, I think, early next week, and with a mutual client, which we won't name. But that deal got really hard because you had a lender that caused some issues, and you were able not only to place it with another lender that's getting that deal done here and is fully approved and we're ready to go and we got the green light, but you were also able to work with your contacts, not only the broker who we mutually know as well at Marcus Millichap, Daniel Cunningham, giving him a shout out, great guy, but also the seller's attorney, and we were able to get that extension mostly because of yourself and able to explain the situation and to work through that. That's the added value that you can't really explain that up front because hopefully it doesn't happen on every deal, and it doesn't happen on every deal. It's kind of the more rare exception, but there is something on every deal. There's some fleas and ticks, as we call them in the industry, on almost every deal. And you know, resolving those fleas and ticks in a timely fashion to make sure that the deal gets done, buyers don't lose their deposits. That's the number one most important thing. So, and you can do that. And I'm just giving you credit for that because we've worked on so many deals together. So
I appreciate that.
That's why you're here today.
I think that's like a big part of that is like the relationship thing, right? And you build strong relationships with all these lenders. You know them all. You've done transactions with them. They trust you. So things move a little bit faster.
And the brokers too. So the multifamily brokers in this industry, I know that David has great relationships with all of them, right? And you know, having that trust where the broker can go to, a lot of times they're on both sides in the multifamily industry. They're getting the seller side and the buyer side, not all deals, but many of them. And they're able to go and vouch for the buyer and vouch for David and the work that's getting done, and go to the seller when they go with a request or something, an addendum or whatever it is. And he comes with that reputation. So that's important to have.
And I've had seller agents call me and say, listen, you sure you can get this done? And my goal is, I keep saying that word goal, I apologize. My way I operate is I want to make sure everybody understands that what the truth is.
Yeah.
I'm not trying to get anything past the goalie because it's going to be found. And maybe my experience as a lender and having to deal with my underwriting team and understanding what the lenders that I go to have to deal with in their back office. If someone comes to me and they show me an offering memorandum and it shows all the financials, I'm going to underwrite the way the bank underwrites, not the way that the selling agent underwrote the deal. I'm going to tell the borrower this is what I can get for you, and these are what the parameters are going to look like. They're going to still either be under LOI, under contract, or in their inspection period. So they're going to know this is what I can accomplish. And again, if it makes sense, they move forward. If not, they drop the deal. I'm working on one right now where he needs to close by 21 days. And I said, there's no possible way I'm getting that done unless we're going hard money or bridge. And he said, I've got cash to close. Don't worry about it. Just get it done.
Okay. Wow.
As long as I know that, then I'm fine with it.
As long as you have a parachute, because you're managing the buyer's expectations too, and saying, I probably can get this done, but having such an aggressive time frame, do you have a backup plan? So that's great.
My phrase is more
don't overpromise, and under deliver.
Same vein is I don't want to use a parachute. I need enough. If I'm taking that plane off, I need enough runway to land it.
Yeah.
And if you're not giving me enough runway to land it, I don't want to start.
Yeah.
And I'll tell them that, and I'll drop or. I need to go hard money. I've gotten a hard money deal closed when the person said, I got my guy. And then on a Thursday afternoon, he said, my guy just dropped me and I need to close by Tuesday.
Wow.
So Friday through the weekend, we all worked on that and got it closed by Tuesday.
Amazing.
Now, I don't want to do that ever again because you took 6 weeks of stuff and compressed it into 4 days. But
so you literally worked, 3 full days. Yeah.
Exactly. So
12 hours a day and ruined a weekend. But I get it.
It got done.
Yeah.
And fortunately, all the lien searches and title work had already been done for the other lender that he had worked with. But so things are, when people ask me, can you get this loan done? I can get debt for anything. And I don't say that braggadociously. I just don't know the cost of those funds.
Yeah.
And I don't know the leverage.
Yeah.
So those two, if this office building, let's say it's worth $10 million, and you say, can you get debt for it? Yes.
Yeah.
Now, it may be 20% leverage, and that may cost you 10% because of the tenancy, et cetera. But I can find a lender. I've been doing this long enough. I know enough people with money that will lend. Mm-hmm. I just don't know what those two factors are going to be. The deal's going to tell me that answer.
Yeah, exactly.
And I get questions, can you work with foreign nationals? Yes. Then my list comes up in my brain like you would look at a decision tree. Do they have other U.S. assets? Do they have a U.S. bank account? Do they own a home here? Have they, what country are they from? Do they work with the government of that country? There's all these things that have to come through. And then I say, okay, here's a subset of banks I can go to.
Mm-hmm. That are foreign investor friendly. There's only a handful of them that are really great.
Yes.
But you know those, which is great.
That's my job.
Saves the time, energy, stress, and possible failure of a deal that people may have trying to shop around and go to 20 different banks.
And I will honestly admit, very few people want to do my job.
I don't want to do your job.
of a buyer and seller typically that are trying to get a deal done. I have a bank who's doing a thorough examination of every nook and cranny, and you have an underwriter back there with a magnifying glass trying to find things. So my procedure is to ask a lot of questions. Sometimes I'll have a conference call with one of the brokers, and they're saying, I can't believe you asked them that. I need to know your background. I need to go blue-collar crime, white-collar crime, foreclosures, deed in lieu of foreclosures, anything that's going to pop up on a background check or a credit report. If I know it up front, I can now find the mitigant for that. And so when the underwriter or the credit officer looks at the deal, they say, oh, I see this. Oh, here's the answer already. So they don't ask any more questions.
Yep. True. Could you maybe give us a couple examples of some very common commercial programs that you offer? I'd say top 2 or 3 based on popularity. For example, purchasing whether multifamily or commercial, mostly stabilized asset. Rents are pretty close to being where they need to be. Pretty. We'll call it nothing's easy, but let's say an easier deal versus, let's say, someone who's buying a multifamily that half the units are vacant, or they're going to have to evict half the people, and the rents are 50% of what market value is, and it's not stabilized, and they need some bridge debt for a year. Explain to the audience sort of what those 2 or 3 top options for programs are.
So the most common commercial loan in the under $10 million loan amount, so let's say anything from $500,000 to $10 million, is a 10-year term, a 5-year fix. So it fixed for 5 years, and then it resets to whatever the index they used. Usually there's 5-year treasury plus a margin.
Okay.
And if you're looking as a back of the envelope of what are today's rates like going to be in the market, just take the 5-year treasury and add about 2.5 to that.
Which is what, 4.7?
Radio,
What is it?
4.64 this morning.
Okay.
So you're
Plus
looking at 2.5, you're in the low sevens.
low sevens. Got it. Okay.
I have lenders right now that, like the deal I just got approved, in the upper 5s to about the low 7s is the current sweet spot for most lenders right now.
Got it. But that's the average, yeah.
That's about average in that range. So on multifamily, 30-year amortization is common. It's not the given, but it's common.
Okay.
On other commercial property types, it's 25 years or 20, depending on the lender.
Got it.
So the most common is that commercial real estate is the programs on lending side are set to have some type of horizon at 5 or 10 years max.
Okay.
There is offer for, you can get 3
Interest only? Can you do?
So we'll get into more.
Go ahead. Sorry, I'm interrupting you. Go ahead. You're doing a great job. I'm interrupting you.
We'll get more granular.
Yeah.
But
Go ahead. Yep.
You can do 3, 5, 7, or 10 is the most common intervals you can do on the fixed periods.
Got it.
Most common is 5. Then you get to other aspects of it. Now, when you get into deals that may not be stabilized when you're buying them, if they're not stabilized and need a lot of capital improvements, you're looking at bridge debt may be most common. Bridge debt, by the nature of it, takes you the bridge from point A, where you're buying the property not stabilized, to point B. And bridge has a lot of variations between it can be totally vacant, or it needs some cash flow, just doesn't need to debt service at the amount that would need to carry the property. And let me go into debt service. On the commercial side, which differs from residential, the property has to pay its own bills. Usually it's a 1.2 to 1.3 debt service coverage ratio. An example of that would be if your net income after all your expenses, true expenses, not depreciation, but true operating expenses, is $130,000.
NOI.
Your net operating income, NOI, then your mortgage payment annually needs to be $100,000 or less. That's a 1.3 debt service coverage ratio. At a 1.2, obviously, it's 120 NOI to $100,000 of mortgage payments, just principal and interest. That's how banks are going to calculate it. So the bank may say their program allows for 80%, but the NOI and debt service coverage at 1.3 only allows for 65%. The bank's going to keep lowering the loan amount until they hit that ratio. And
The loan to value you're talking about, right? Yep.
Correct.
Yep.
And in that, they're not going to take what the seller says or what the refinance owner says is their financials. They're going to look at their rent roll. They're going to look at a profit and loss statement, and then they're going to reassess taxes to what the new value is proposed to be and what the millage would be. And even if it's a refinance and they're not going to reassess the tax because no capital event happened, no transfer of the property happened, they're still going to look at it as if we have to foreclose, it's going to reset. And then what are those taxes going to be?
And that's different from a resi loan,
Different from resi loan.
So
resi
just like-
looking at debt to income ratio.
right?
Yes.
And they're not resetting the taxes.
They're not resetting the taxes. Then they're also going to look at the new value. So if your current insurance is giving you a replacement value of $1 million, however, we know when it gets appraised, that replacement value is going to be $1.5 million, they're going to reassess the insurance to what it's going to be to cover those things. So they're also going to provide a vacancy factor, whatever the market vacancy, typically about 5% on multifamily. Your property can be 100% occupied, but they're going to apply a vacancy factor. They're going to apply a replacement reserve factor.
And each bank can choose whatever they want, right?
They're going to underwrite
so there's
to
no
their
standard
parameters.
federal
Correct.
regulation.
Some may say 30-year amortization, but they're going to underwrite it at 25 with those same expenses. And if it doesn't clear at 25, they'll lower the amount to 25 to meet their debt service requirements and then allow for a 30-year amortization in the actual loan. So that's their conservative. So, and that's my job, is to know what banks and how they underwrite.
Do 25 or 30, yeah.
Correct.
Okay.
So that's pretty much down the middle with banks on how they're going to underwrite debt to income ratio with their conservative underwrite, and those will be proven up by the appraisal. So they're going to order a commercial appraisal. A commercial appraisal, if you're doing residential and you're paying $500, $800 for an appraisal, a commercial appraisal, the last 4 I've gotten bid were over $3,000. And they take about 2 to 3 weeks to complete. So $2,500 to $3,000 is about a commercial appraisal cost. That and possibly for an environmental, they're going to do mostly an environmental screen, which is about $800, which is a computer screen. If that computer screen comes up with something or their bank policy requires, they'll do a phase 1, which is closer to $1,800. It's an environmental. The good thing is you'll have that report for your file. So if anybody ever asks, you have an environmental report that you can
For
show.
the future.
But the bank will require it to make sure the property is clean.
Got it.
There's the only things you pay for up front is to make sure they're covered on that third party expense. Now to other programs. So you're buying the property and it's $1 million. I'm using $1 million. It's easy to do illustrations on $1 million. $1 million property, and the cash flow only allows for a 65% loan. But you want 75% because you know that the property has a lot of room for growth in their rents. You're going to put in $3,000-$4,000 per unit to get it there, and it's going to take you 12 months to do it. There are lenders that will lend a pro forma, so you don't have to go to bridge. The advantage of that is bridge rates are commonly, they use the number 10 and 2, meaning 10% rate and 2 points of lender fee. Banks that do pro forma are going to be their normal bank rate. However, they're going to allow you, if you're experienced and you have a proof of concept, hey, I've done this before, I know I can get there, and the appraisal proves out those numbers, they'll lend above debt service requirements, so below debt service requirements. So they'll say a 1-to-1 debt service. So their mortgage payment's going to be $100,000 and you have $100,000 in NOI. They're fine with that because they know you're going to get it to $120 in NOI or $125 in NOI in 12 months.
But sometimes don't they require reserves?
So
I've had that on my
yes,
properties.
It may be, and there's different banks.
Until
that
you get the rents up to those
they may
those
do
amounts.
a holdback.
Yeah.
That's
They
what
may
we've
do
done together.
reserve.
Holdback, yeah.
So there's different.
Yeah.
Those two things are different. A reserve.
You're right. They're different.
Yes.
I should have
a
said
holdback
holdback. Yeah.
means that they are going to lend you $1 million, but at closing they're only giving you $750 until you hit those numbers. Then they'll release the rest. Reserves mean they're lending you the $1 million, but you have to keep a 6-month principal and interest reserve that's held until you hit those numbers.
Yeah.
Then other banks require a compensating depository account, so they'll lend to pro forma. They'll lend that first year on interest only to pro forma, knowing that when you stabilize the income, you'll meet their debt service requirements. But they're going to say, we want a 10% deposit. They're going to have $100,000 on that $1 million loan held in their bank for the life of the loan.
Which sometimes defeats the purpose of doing the loan
It
with them
does.
sometimes,
Correct.
depending on your situation.
Depending on your situation.
Yep.
Or if you normally have a few $100,000 that you keep in reserve for things, they're going to have an interest-bearing account. It's just having another bank account. And what they're saying is, we're willing to make this extension of goodwill to you, but you're going to have a deeper relationship with us. Now, some banks won't go to pro forma. They're going to underwrite to day one cash flow with all of those extra higher reassessed numbers and expenses they're going to put on there, and they're going to require 20% of your total wallet anyhow. And they're not doing anything special. They're just saying, in order to do this loan, all of our customers have at least 30% of their total liquidity in our bank.
Wow.
And sometimes their rates are a little better because
Sometimes
of it.
because of it, yes.
Yeah.
And-
But not in my opinion, not good enough in most cases.
They have a model that they use for profitability. Banks are not in business not to make money. They have shareholders they have to satisfy.
Yeah.
So, like I mentioned before, the 2.5% over the treasury. That may not be their cost of funds, but that helps them gauge what they want to charge for their money. Even when the cost of funds was zero, when the Fed funds rate was basically zero, and they were offering 0% on the money that you were keeping there, they still had a 3.5-4% rate, which is a great profit margin for them. Right now, the banks are paying 3.5, 4% for money market for CDs, 4.5% depending on a special. They're not going to lose money. So when they're lending out and they're getting that deposit that we just discussed, when they're lending out, they're looking at how much money they're going to make on that money that they require you to keep there as part of their formula
spread,
as to what's the yield profitability on this loan.
Yeah.
So the bank's business isn't, people will say, but this is a great deal. I'll pay the bank back. They want to make certain that everything is smooth and clear. And the main reason, and they ask for a full accounting, they see a K1 on your personal return, they're going to want that K1 from your, wherever it came from, they're going to want that return. So banks do now, for maybe not as good a yield, they may be a little more lenient on their underwriting, but their biggest concern is they're audited several times a year. Now, back before the CFPB, the Consumer Financial Protection Bureau, came into play, they weren't audited, but it caused some banks to go under, so that they want to make sure the banks are minding their own business while they're lending money, keeping their ratios intact. So some of the documents they ask for are just checking the box. When the auditor comes by and says, I don't see a tax return from 3 years ago, I need last 3 years of tax return based on your policy, they'll ding them for that. I have a deal right now that I'm working on where the guy sold his business December 31st of 24. They still need last 3 years tax returns of the business he sold that have no bearing on the future. But because their policy requires last 3 years personal and business returns, if they don't have it in there and the auditor comes by and they say, where are these returns? They try to say, well, he sold the business. Well, how do you know there was not some shenanigans going on back in those times that you couldn't have underwritten to make sure everything was? So for the just fine
regulations are regulations. Yeah.
Yes.
Yeah.
There's policy, there's guidelines, policy, and regulations. Guidelines, they're made to be here, but things go up and down with guidelines. Policy, you can ask for an exception to policy, and I've been doing this long enough. I know where a policy exception will be granted. I know how to request. We want interest only the first year if we can get the first year of interest only because they're repositioning the property, whatever it might be. And can we get only a 1 or 2 year prepayment penalty? I'll go to prepayment penalties in a second. So I'll negotiate those things, and policy doesn't allow for it, but we get an exception to policy because of other mitigating factors. Then there's regulation. Regulation is the government saying you have to do this. Your attorney's going to give you guidance on this, and if you don't do it, we're going to ding you.
Got it. But that's another added value you're bringing to the table. You're negotiating for things that most borrowers wouldn't even know to negotiate for.
And that's the big difference between like a resi loan and like a commercial loan. When you get the commercial loan paperwork, like you can read this and possibly negotiate some of it, right? If you get a resi loan, you show up, you sign it. That's how this works, right? You either take it or leave it.
These are federal government programs on a resi loan most of the time, unless they're non-QM, but that's a different exception. Yeah. Well, that's great. All good info. And then what about bridge loans? I don't think we touched on that.
So bridge loans, again, they take from point A to point B. Most of those, you're going to have more of a heavy lift. They will go to 75% of loan to cost. So you're buying the property for $3 million, you're putting $1 million into it to take the NOI from $100,000 to $150,000. Where we talked about on a commercial loan from a bank and bank type lenders, they underwrite day one cash flow, they underwrite with the reassessed taxes and insurance. Bridge lenders underwrite to the exit. How is this deal going to exit into a non-bridge loan, into a comfortable amortized commercial loan, into a Fannie or Freddie agency loan, into another type of loan, so we can get it off our books. The bridge lenders or hard money lenders want to know what your exit plan is. How are you getting out of my loan? Where the bank wants to keep you there as long as possible.
Right.
The bridge lenders,
they make most of the money on the points.
Yes. 18. Well, they make good interest.
Good interest too. 10 plus
18 to 24 months. Those 2 points give them on a 10%. Interest only, it gives them 12% on a 12-month, gives them 11% on 24 months.
Sure.
So that's what they're returning to. Most of those bridge lenders have investors who are looking for the return as well. So that's why they're doing it. And it's obviously higher risk because the project isn't near cash flowing to where it needs to be, but they've underwritten the risk and they say, based on where this is going to exit out. Now, bridge lenders got caught in a little bit of a conundrum over when rates went from 3.5. So they're underwriting to, let's say, a 4% exit rate when all of a sudden the exit rate was 7%. Now we did what's called, which is the first time in my career in 20 some odd years, cash in refinances. So people had to bring cash to the closing table in order to get their refinance.
Wow. So like on syndication deals where there's 100 investors, they may have to
capital
calls have to refinance the deal, meaning put more money in.
If they went with bridge initially, if they went with something that was a big reposition, that someone was coming in and buying something that had a lot of upside, but you're buying it going in at a 3 cap and you're going to perform at an 8 cap, meaning your yield is going to go from very little. So if you're borrowing at 10%, your yield, you're losing 7% until you get it stabilized and then reposition it to 5% debt. Now you're making 3% yield on your levered portion. So the investor that does that has to be skilled and understand what they're doing. But the bridge lenders learned a lot from there. So their underwriting exit may change so they get more experience.
It's still happening right now. I got a guy that he has bridge debt for like, I don't know, $1.5 million on this thing. And he wants to sell it, but I don't know if we're going to get it done at 1.5. It's probably going to be less than that. And so now we're trying to
Does he have money to bring to the table? Yeah.
We'll see. We'll see.
There are specific grassroots lenders that offer that mezzanine now. Yeah, they offer that mezzanine equity to get people out of those. It's a cottage industry actually that a lot of the large lenders added that component.
Wow, interesting.
Yeah. So that for those cash in refinances, because people aren't going to be able to come to the table with more cash, they can borrow it.
Yeah.
At even higher rates, maybe.
So we try to set him up.
Usually
with
they're
that.
going to agency, so they're going from the higher rate to a better rate. So they've been paying and performing at the higher rate. So that's why they'll give them the money to cover that gap, knowing they can perform there.
So he stopped paying. Big problem.
Oh,
Oof, okay.
So now so this is past like 2 months of not paying. And he's trying to do that because that's what I suggested to him. Like, keep the property, figure out how to get out of this bridge debt. Well, yeah, we might need to talk after this.
Yeah.
So we need to talk because he hasn't been able to get debt at a better rate because of him not paying.
Yes.
You know what I mean? So
banks
that's,
don't like when you don't pay.
yeah.
No.
Yeah. I'm like, man, who told you to do that? Yeah.
Yeah.
'Cause I think he can pay it. He's just not like, anyway, moving on. I wanted to comment on the points, because that's a little different from the average person that might be watching this. That's different from a resi loan in most cases, to a commercial loan. And that's something that you negotiate frequently too, right? So
points are it's a percentage of the loan amount. So if the loan amount's $1 million and the lender, usually when you go off the street to one of the lenders that I use, they're going to charge you about 1%. But when we go to them, they charge between 1/4 and half, because I'm charging 1% minimum on my deals. So that's what the industry standard is for what I do for a living. That's how I make my living.
Exactly.
Back before 2010, there used to be something called yield spread premium, where the bank would let me upsell the loan and make a premium on the back end, so I'd have to charge my client directly. They'd pay for it for the life of the loan, and the bank would make a little bit. But they got rid of that with the CFPB. No more yield spread premium for the most part on any loan. So like everything else, it's going to show up on the settlement statement. Everything is above board. Yeah. We agree to everything beforehand. I let you know what I'm going to do, how I'm going to do it, and the fact that I'm going to get this loan closed. I'll present with options to you. If you say, yes, this looks good, you'll sign my agreement. Then I'll introduce you to the lender, and we'll move forward from there.
So that's points. What about prepayment penalty, which is also different from a resi loan? Yeah.
Most commercial loans have a prepayment penalty, and there's 3 types of prepayment penalties. There's a simple percentage, there's yield maintenance, and there's defeasance. And I'll start with the easiest one first and go more complicated. Most loans, if it's a 5-year loan, it'll have a 5, 4, 3, 2, 1. So if you got out of the loan in the first year, you'll owe 5% of the loan amount. Second year, 4%, down to 1% for the last year, and there's open period at the end.
And usually, if you sell it, you can. There's like all these different things that you negotiate,
correct.
Right?
So then, I'll always ask you what your business model is. Is this a long-term hold? What do you think you do with this property? Because I need to know about that, because prepayment penalty.
If it's a flip, if you're trying to do a 12 to 24-month flip,
if you're looking at, listen, I am buying this property, a lot of upside. I'm going to grab it. I may be in it for after I turn the units, get the rent stabilized, be in it for a year. Then I want to sell it. I'm going to time the market. And great. I want to make sure that your prepayment penalty is negotiated down to no greater than 3 years. So that last year is 1%. So you're stabilized in your second year, and you say, my third year I'm going to sell it. You'll know better the timing. But I'll know that that's what your plan is. If you say this is a long-term hold, lenders, some of them have what's called yield maintenance. And that is that whatever yield the investor would have gotten from the interest on that loan, if it's a 5-year loan and you get out in the first year, you owe 4 years of yield. Same thing goes now. That last year, that 1% that may have been on a 1% prepayment penalty, the yield maintenance may have been lower than that. So that may not be a bad thing if your plan is, okay, I'm going to hold at least 5 years. If we get better terms with yield maintenance, that makes sense. Then there's defeasance, which is a whole calculation. And yield maintenance is similar. By providing the yield, how they do that is they buy a bond. So I've had it in my career a couple of times. I hear people talk about, you could be in the money if you do this swap loan. You could be in the money if you do this defeasance loan. Well, first, you got to make certain that, one, you own the swap. So there's a difference between the bank owning the swap and lending to you and you owning the swap. So if the bank owns the swap, you're going to have a prepayment penalty of minimum 1% no matter what. And if they're in the money, they win. If you own the swap, what happens is you borrow and the rates are really low, and then the treasury yields go up, the bond yields go up. When you get out of the loan, you can buy that bond with that amount of money that you're paying off, and all of a sudden you made more money because of a higher yield versus if you borrowed at 7% and the bond yields are selling at 3%, you got to buy more of a bond to pay off to get that same yield.
So it's really just insurance. You're buying the option, essentially. You're paying for an option to have insurance. Yeah.
It's not insurance.
It's not true insurance. I'm using an analogy.
Correct.
It's yield insurance.
But there were on bridge loans, they were selling what's called gap insurance for a while, where they required you to buy gap insurance because rates were rising so precipitously that they want to make sure that you could.
That's true insurance.
That's true insurance.
Right.
That's a rare occasion. They'll offer it, but a lot of times people, I'm not going to buy it. It's only prepayment penalty. But a lot of times they were requiring that.
Yeah.
However, I never say that because what I tell people is if you're getting into a loan that has a defeasance or a yield maintenance, it could be very painful if you wanted to get out before this. It may not be, but I want to let you know, heed my words, all of a sudden the economy takes a downturn, rates go down, you're struggling and you need to sell the property.
What just happened here in the last 2 to 3 years.
Painful. Right.
Yeah.
And the one I had that was in the money, they got an agency loan. We got an agency loan for them. And I'm sorry, I apologize. They got a swap loan. And we're going into agency, and they made $120,000 on selling that swap and being in the money, and then going into the agency loan because of the way the rates went, they benefited.
But that's a gamble.
I've been doing this 20 years, and it's happened a handful
of times.
A handful of times.
Less than a handful.
Yes. So those are the prepayment penalties. I'll fully discuss that, but be knowledgeable of it. What typically happens when I call somebody, we talk about their debt. And so what's your loan like now? I have a loan, yeah. When's it due? I think in a couple of years. How much is it? Well, I borrowed a couple $1 million. Do you know what you owe now? I'm not sure. What's your monthly payment? Let me go look. Is there a prepayment penalty? I got to check my paperwork. It's amazing. That's the typical conversation because this is a multi-million-dollar loan. And the resi side, most of the people like, well, a jumbo loan, what is now, 600 or lower? I don't even remember anymore.
It's about 600. I think it's 590 or maybe something like that.
I could hardly find a bank that wants to do a commercial loan that's under $1 million because it's just the effort that goes into it is like for a commercial loan, $1 million commercial loan is just as much effort as a $10 million commercial loan. But the profitability is a lot higher than $10 million, so people want to do those.
Sure.
Yeah, usually what we've experienced is, at least me and my partner, when we're doing this stuff, because we have a number of properties that are maybe $1.5 million, range. It's like they'll do it with the hope that we have a relationship to build, or they'll get the bigger loan one day. It's more of that than just like, yeah, we love doing these loans, right? Yeah.
It's a time sink for them, and they're onboarding the loan, the annual reporting they have to do. So a difference also in residential to commercial. Some banks require annual reporting. Sometimes just the property level information, and sometimes it's a new examination of you every year.
Yep.
And it depends on the lender. So I have someone that wants to get out of a loan, not because the loan isn't good. It's because he's sick and tired of every year, this time of year, worrying about having to do a full disclosure of all of his financials again. Yeah, some lenders require that.
Oh yeah, I do it. I mean, I do it every year with the different banks, right? So it's just.
And what Larry just said is important. What you said about different banks. My partner and I say, today's bank is not the same bank that may be the best for your deal tomorrow, because the banks change their programs. And on the deal you discussed that there was a change, they decided at the end of last year they were dropping the program that deal was on, and this deal, because it wasn't fully baked yet, they just dropped it.
Wow.
And instead of the $2.1 million they were going to lend, they said, we'll still do the deal, but at $1.3 million.
Wow.
When that happens, the deal is now dead.
Yeah.
Because someone's not changed. So we found a new lender to fill the gap, and that's part of my job, is to have backups and understanding of that. But you may say, I went to this guy. Another client that came to me. He wants a 35% loan. I said, why don't you go back to the bank that has the mortgage right now? Because they changed their policy in that they now underwrite to on prime plus one, and prime being 7.5 right now, that's an 8.5 mortgage, where I can get him probably at that low of a leverage, 6.5 or lower. I can also, in South Florida or Florida in general, windstorm is a big deal with regards to cost. I have 4 or 5 lenders that won't do windstorm, but at that leverage, I have about 10 lenders that will waive windstorm if the loan amount is with more than 10% or 20% lower than the land value. So his land value is $1 million. He's looking for 600. All day long, they'll do that loan without windstorm, because if the windstorm comes, they're still
wipes
whole.
out the property.
Correct.
They're still whole.
We were we were looking at some different options for some of the lenders we're already with, and some are waiving windstorm, some won't. And you look at that refi rate, and when we associated what the cost of windstorm is per year to like a interest rate per year, it's almost like 1%.
I've done that analysis. That's pretty interesting.
Yeah, I guess it changes on property value, but for this specific deal, it was it was like one percentage point lower. Ideally,
Huge
like
difference.
yeah. So like the savings is like that's substantial when you're doing stuff like
Now
this.
during hurricane season, there may be some heart palpitations when
There's a risk to it.
Yeah.
It's a risk reward.
The way my clients underwrite that, so one of them, and I really thought it was very interesting, was he not only looks at that savings, he also then calculates in, if this happens, my deductible is going to be $65,000.
I may never meet my deductible.
Right.
Yeah.
But that and my yearly premium for this property, just windstorm, is $13,000. So in a 5-year period, let's say it's $10,000, $50,000 plus the $60,000, so I'm at $110,000 in 5 years that I may not have that much damage, or I can save
Put it in my pocket.
$50,000 because windstorm. I say to clients when they look at me, well, but this rate's 7% and this one's 6.5%. Just need to make sure you understand mortgage interest is deductible against income. Mm-hmm. So your mortgage interest rate is less important than the structure of the loan. Now, 2% difference is a big difference. But if I get you interest only for the first year and the rate's 0.5% different, you're saving on your monthly payment a lot, but that same mortgage interest is deductible against income. So that is a thing people don't think about when they're looking at rate. That the additional rate, yeah, it stinks on your monthly payment, but you're deducting all of that additional interest against your income.
Yep.
Yeah.
So it does have a benefit.
There's a benefit.
Or people say, I have the cash to do it. Well, if you have, let's say it's 1031 money, and you have $1 million, and you want to buy a $2 million KFC. Well, $1 million KFC, let's say. KFC's aren't going for $1 million. A Wendy's franchise, $1 million. You buy cash for $1 million. Or, now remember, the tenant takes care of taxes, insurance, maintenance, everything. It's triple net. Or you can buy 2 Wendy's, getting a loan, and while your yield may be similar, combined, your blended yield, 4% on $100,000 is a lot more than 4% on $50,000.
Yeah.
So you're owning both of them.
It's true.
So you have the same 4% yield, but your actual total income is more because you have double the rents.
Yeah. As long as you have similar yields between cash and financing.
And that's what we'll go. We'll go through all the numbers and make sure it makes sense. But clients look at, well, I want to buy it for cash. Well, great. But if you do it this way, you can actually get more and you have a bigger portfolio and you're using the debt because while buying for cash has its benefits, you don't get the deduction.
And then tax deduction,
the mortgage interest.
Yeah, yeah. No,
So
that's
it
great.
does have a benefit that people don't look like. Principal pay down is also the benefit. So while you're looking at that $100,000 of income coming to you after your debt service, et cetera, the tenant's also paying down that $1 million mortgage. So in 10 years, when you look at this and say, well, now my mortgage is $90,000 $900,000 versus $1 million, I made X amount per year, plus they gave me $100,000 of equity by paying my mortgage for me.
Yeah.
So there are benefits to doing it when you're looking at. I have a lot of people that were only
And of
cash
course,
buyers.
appreciation of
just
2
gonna make that-
properties
Right.
versus appreciation
Exactly.
of 1.
I was
That's
going to make that comment.
yeah.
You take 2 Wendy's at $1 million each, and you only put in $500,000,
Right.
and the Wendy's double in value over X amount of years.
Right.
That's not a 2x return. It would be if you
Right.
spent $1 million on one Wendy's, but that's a 3x return on each Wendy's.
And
right,
you
or
say
something like that because you're putting $500,000.
I bought one with a 20-year lease and one with a 15-year lease. In 3 years, I'm going to sell the 15-year lease with 11 years left and keep this one because it's the longer lease.
Yeah.
Now you take that and you parlay that in your next asset, and you still keep one. It's ways to grow your portfolio to use debt.
accelerate.
I have some clients that say, I want to max out. Tell me what the max leverage you can get on everything. I want to pull all equity out at all times. I have other clients that say, I don't like to stress my properties. One of my clients said, if the cow is giving you sweet milk, why stress the cow?
Well, it's also a situation in life you're at. For example, same broker, Daniel Cunningham, he put a client a year and a half ago into a nice gas station deal that was triple net. She's retired. She had a nice,
finance that.
a nice tranche of money she got. I think maybe it was for her husband who passed away, and she got some life insurance. And this was just an annuity, essentially, more or less. So if you're 65 years old, you may not want to go aggressive and stretch yourself or stress yourself. You may just want to have that cash flow and have cash deals. Fine. That's a different time of life versus someone maybe who's our age is in the mid 30s or me in my late 40s, and I want to go gas pedal to the floor.
It's funny you say that because most of my clients that say, I hear about these triple net properties. Tell me more about them. I said, okay, you're in apartments right now. Mm-hmm. Your way you make money is by increasing your revenue and decreasing your expenses. Now, what I can do for that, if you have debt on there, is maybe reposition your debt if things get better. When you look at this lease for this KFC that I'm doing right now in Tallahassee, the guy sold his building that he had his business in. He's retired, he wants to travel, and this will give him $80,000 a year in mailbox money. And then when the bumps happen, he'll get more. This is after debt service. But I also said, so when you look at that lease, that's all you can make. You can't impact anything on your income or expenses. Now, this is the one that's at 5.82%. We got now, let's say in 3 years, rates get down again. I hope, and I'm saying this to the camera, hope rates never get down to where they were during COVID, because that means that
things went
all
bad.
heck breaks loose again.
Yeah, exactly. That's really bad.
Right.
Yeah.
A normalized, in my view, and I've been doing this a long time, if rates, strong deals in the 4s, deals that are good are in the low 5s, weaker deals in the high 5s, and bridge is still going to be 10 plus 2.
Yeah, yeah, always.
Yes. But in this deal, if in a few years rates get down in the 4s, we may say, okay, let's reposition your debt. Or now that you have rent bumps, you can sell into that next bump and rates are lower, so people can give you more money for this asset. But the hardest thing with someone who's younger in doing that is, you mean I can't do anything? I can't change? Nope, that lease is what it is, and that's what you're buying. You're buying an annuity because it's spelled out in the lease with a guarantee from whoever the tenant
And
is.
when you hit a situation like 2020, 2021, where we printed trillions of dollars and inflation spiked and our dollar is worth 50% less than it was, 4 years ago, that's tough when you're on a more or less fixed income like that. You're making $80,000 a year. Well, the $80,000 in 2020 is not the $80,000 in 2025. You can't change it.
Yes.
That's a problem.
And I promise you, the corporations will, during that time, they did call and ask for renegotiated leases.
Oh, I'm
and
sure.
My client came to me and asked me, and I said, if you say yes, then they have you. If you say no, it was a Hooters in Kentucky, and it was coming up on football season, and they wanted to stay open because they were making money. I said, if you say no, they have to pay you. And it's Hooters. They're not going to they have to shut the store down because you can call them on that and kick them out, but they are leaving it open for a reason because it's profitable. They're just trying to test you to see if they can renegotiate it.
Absolutely.
Now, it depends on your opinion. You can do it if you want to, if you don't have to.
Yeah.
It's your decision.
Yeah.
But back to they're all, every asset that you're going to buy, if you're looking at, should I put debt on it? It's a conversation to have.
Yeah.
I always like to approach things from a position of knowledge. I have some clients that are coming up on maturities in June, July of this year. And I have 2 of them calling me recently. What do you think I should do? Let's look at it today and do an analysis on everything. Then we can try to time the market the best we can because you have time.
Yeah.
If you look at this in April or May, we got to go.
Yeah.
If we look at it now, we can plan ahead and get you into something more comfortable, make sure we do dot all our I's and cross our T's before we get started and we're not under pressure.
Yeah.
The first thing you do is you go back to the incumbent bank and say, this is what I'm looking to do. Do you want to keep me as a customer? If yes, then we need to look at these aspects because that's your cheapest way to go. I can have that conversation with you in the bank to make sure that everybody's understanding and speaking the same language, but that's the first place to go. Then if that's not a good landing spot, then we look elsewhere.
Good. And do you find that sometimes banks they got you in a 10-year loan, you're at your 5-year reset, they will negotiate to kind of keep you within the loan. They'll modify the loan a little bit sometimes, terms.
Sometimes.
It's a discussion.
It's a discussion that you want to have because
especially if you come loaded with, hey, I've been talking to another bank and they're maybe willing to offer.
You bring me in tow,
because of you,
right? You bring me in tow, and I'm on the
Yeah.
conversation. Listen, we're talking, and he really has a good experience here. This is what's going to happen. His loan's maturing. What will you allow for to happen? Will you negotiate based on these factors? Because the cost of closing costs for a loan, with my fee included, and we've studied hundreds of loans that we've closed. Obviously, a smaller loan, there's certain things like lien searches, like title search, like appraisals, like so certain things are per deal. They don't change.
They're just fixed
$10 million deal is going to be a $3,000 appraisal. A $1 million deal is going to be a $3,000 appraisal.
Yep.
Can't change that.
But your doc stamps and your title policy we can give you reissue credits.
Correct. And those are things that have, and doc stamps are based on loan amounts.
Based on loan amount.
But it's about 3% of loan amount is total closing costs, including your fee, my fee, all things all in. It's about 3%. If it's a $10 million loan, maybe 2.75%. If it's a $1 million loan, maybe 3.25%. But I've studied too many to know that's about where they're going to settle. So figure that. But if you did a modification with a lender, or you did a refinance with the same lender, it may be 1% to modify, for loan docs to be rewritten and modified, to re-record, etc. There's some small fees. So it's a lot cheaper to do that, and you're not repaying doc stamps. You're not
policy and doc stamps are the two biggest fees, and
exactly.
Doc stamps are way bigger than the policy. So if you can save that, it's huge.
You can save that, and also I don't want to do all the work and have my lender partners do all the work, and then you go back to your incumbent lender, and then we'll match that. And now, if you have an engagement agreement with me, now it becomes a legal issue that, hey, you signed an agreement for me to do all of this, and then you just, so that's why I want to have the conversation up front. Make sure that the decks are cleared, we know what we're facing, and we're exploring all the options because, and I tell clients frequently, it's not that you have to do the loan with me. I want to make sure you're in the best position. If moving forward with me is the best move to make, let's do it, and I'll earn my fee. If not, I'm going to guide you to, and the guy I was talking about, the helicopter pilot earlier that I mentioned, when we were first doing that loan, I said the seller was like, I don't want to hold paper. I said, do me a favor. The seller's trying to get this number. Have that conversation one more time because you need to make certain, because the loan I can get you right now, because the property's so low in its income because they've mistreated the property and you need to put so much into it, is going to be more bridge debt. And bridge debt isn't really it's expensive. So went back to the seller and they made an agreement. And he was able to do no windstorm because he needed a new roof. The only thing the seller put on there was 1% prepayment penalty no matter when he gets out. So he has an exit fee to get out of the loan, and the seller's a maximum of 3 years. So he's in the loan. He got repositioned the property. Now we're going to do an exit for him.
Awesome. That's great.
I want to hear your thoughts, just because you're so close to this. You're doing a lot of financing work. Thoughts on the market. Just what's going on. Are you seeing loan volumes up, transaction volumes up, down? What are buyers like? What's going on?
So right now, I would say, let's start with property type.
Sure.
Right now, office buildings, we have several lenders that say, unless it's a medical, all medical, and walks on water, we're not touching office right now.
Wow.
Okay.
I have other ones that say we'll do office, but no greater than 50% leverage.
Okay.
And it has to be, obviously experience, and that's the hardest property type right now. And that does change. The best
They're scared.
property type,
Lenders are scared.
It's always cyclical. There's a time that hospitality, you could do hospitality. Now hospitality's hot. Same thing with single tenant net lease. For a while it was tough, and a couple lenders just back out altogether, and it's back on. But a single tenant net lease, Walgreens is down because are they going to renew leases where they're at currently? That's always a conversation. Yep. Okay, I had a guy who looked at one in Lake Worth, and I did a little research. There's 10 Walgreens in the 5 miles of there. Their lease is up in 3 years. They're not going to renew. And they had a lease that had a percentage rent in there, which meant that they paid a percentage of the revenues on top of their base rent.
Oh, wow. Nice.
So different types of tenants like that, during different epochs of their existence, they signed different kind of leases. There was a series, I think it's CVS, that during a certain development period signed leases that had a 3-year rent vacation at the end of the lease. So it was a really solid lease with bumps, but the last 3 years was rent vacation. Wow. They built that in so the landlord, whoever owns it, mom and pop, that sold an apartment building that bought a CVS, if that last 3 years you can't sell it, it's got no rent, and if they don't renew, they have 3 years of ramp time to go to a new location or do. Yeah, that wasn't a good lease. So it was hard to get those financed if they were drawing down because nobody wanted to touch the last portion of that lease. So again, those are things through experience that we know about. But now those are back in favor, the most part triple net leases, depending who the tenant is. Then the bread and butter is always multifamily and small bay warehouse or industrial because they don't build much more small bay industrial. Just doesn't happen. And the way I look at it, the tenant for those small bay industrials, that's where they make their living. That's their cabinet shop. That's their machine shop.
Yep.
That's their plumbing supplies, whatever it may be.
They
If
can't
don't
have
pay that
interruption.
rent, they can't pay anything else.
Yeah.
So they always pay that rent and they always stay pretty full. Again, they don't build much more of that property type. They can't get zoning for it, and it just.
I was working with a client who was looking for stuff like that. And I mean, down here, it's like there's
They don't
just not a
trade.
lot of it.
Yeah, they don't trade.
It's not a lot of it. Yeah.
When they do trade, they have lots of offers.
They have lots of offers, and usually, a lot of times, not always, but it's an end user, owner-occupied deal. So, like, you get a lot of guys who are they just need a space, so they'll pay more than the average investor would, who's going to lease it out, right?
I
so
said that to somebody yesterday, an owner-occupied, that if you're looking at apartment buildings, you're looking at NOI, NOI, NOI. You may look at locations, see, do I want to be in this market, whatever, but you're looking at different apartment buildings based on what you can make. On owner-occupied, if it doesn't meet your business needs, it has no use for you.
Exactly.
So it has to meet your business needs, and if it meets your business needs, you'll overpay because that's going to satisfy what you need to do.
I did one here in East Boca, like a $2 or $3 million transaction, and same thing. He was renting like literally a couple doors up, the guy who I represented on the buy side. And I found this off market, whatever. I brought him through and it was just like, well, this is a no brainer. And we wanted to pay like, I don't know, in the ones, like the high ones. They didn't want that. The seller didn't want that. We just paid the number. That was just it. It was just like, all right, fine. This is it. And he would have done it just because everything worked perfect. Right.
That's why you're buying, similar to why you're buying a house. With schools, with shopping, near your work, whatever, what we do is investment property, people making money on cash flow, and that's why they're buying it. Now, we do a small portion, maybe 15% of our business is owner-occupied. SBA,
You do SBA loans.
SBA loans.
Okay.
So SBA has two types of loans. There's the 7A, which is business. There could be real estate involved, but it's mainly business. The difference to that is higher rates. The bank holds the entire loan. They have a backstop from the SBA to do that. Then there's 504, and 504 gives better terms. Both of them can go to 90% leverage. 504 stands for 50-40, 50% held by the bank, 40% held by the SBA. It has three parts. It has the initial 50% loan from the bank. It has a second mortgage that either the bank will offer or use a third party for the second mortgage. And then usually about a month or so later, and everything goes through, they issue what's called a debenture, the SBA, and they buy all those second mortgages, and they hold that for 25-year fixed, and it's usually a really good rate. In my view, you go SBA when you have to get the leverage, because SBA is not going to be the best rates, but they're going to be the best leverage. They're not going to be the best terms, and I commonly say, put on a football helmet, bang your head against the wall for a little bit, and then you're ready to go. It is mind-numbing.
We went through this exercise with that guy. Yeah. He had a bank that he worked with directly, and we exact same thing. But fortunately, he went seller finance. The seller financed it, which just became like the easiest thing ever. Yeah, we were just like,
if you can ever get seller financing, it is the path of least resistance. It guarantees the close. Everybody's gonna get it done. It may not be the best. It's a little more complicated. You need somebody like Jerron to make sure that
we do that a lot.
It's
Jerron's a lot of
Don't just go online and get legal docs. Make sure you have someone doing it.
Please go to ChatGPT to work up your mortgage and note.
You don't want to do that.
Stuff like that.
If someone asks me if they have an opportunity for seller financing and it's something that isn't stabilized and has some hair on it, needs some work, that's the path of least resistance.
Yeah.
Then let me do the takeout once you're stabilized.
Yeah.
But and again, I might lose the business up front, but I know that the person's doing the right thing for their purchase.
Yeah. And a lot of times these seller financing deals, they're only 1 to 3 years. Yeah. It is almost more like a bridge loan most of the time.
Most of the time. The one I just did, believe it or not, and I told the buyer, I was like, there's no way we're going to get this. He's like, ask for 30-year term, 30-year AM. I'm like, there's no way. And the guy's like, yeah, no problem. We just did a loan, 30-year AM, 30-year term.
30 years?
It was like, I don't want to misspeak, but it's probably like 85% loan to value.
What?
What's the rate?
Like 6.
Yeah, that's perfect.
Oh my God!
The guy's gonna make a 6% yield.
It was the best.
If your buyer drops out, let me know.
It's done. It's done. I was questioning. They were thinking about walking away. I'm like, if you don't do this, I can find somebody, but I might do this.
Instantaneously.
Like this is crazy.
Yeah.
They paid a higher price for the property, right?
That loan isn't replaced.
With the loan, you can't. What are you gonna? That's insane.
For a while, I don't know when rates are going to climb back below 6. It'll be a while.
But either way,
no prepayment penalties.
Wow.
Just like
if it does, you can get out of it.
That's exactly
wild.
So SBA is that way. However, if you don't need to go SBA, a common phrase in the banking world is if you need the money, it's hard to get. If you want the money but don't need it,
it's easy to get.
You all day. Lend you all day. So if you don't need the leverage, SBA, because SBA is there for small businesses, but if you don't need the leverage, the bank can do up to 85%. So only 5% difference in leverage, but you're getting much better rates and terms. Or a deal we just had, if you're anybody out there is a doctor and looking for owner occupied, 100% financing.
Wow, which is awesome.
Yeah, that's you've done the work, you've gotten your degrees, you're in practice. Lenders will come to you and say whatever you want. But you need to know the right lenders. Is most are going to say 80, 85% if you go off the street. but we know who will do 100% financing for medical specific.
Okay. Yeah.
You were, before we jumped on this thing, you were talking about a pretty awesome product you have for the multifamily. The 5 1/4 rate.
Oh,
yeah. Like
that is, so
Figure you comment
Larry's
on that.
mentioning something that we were talking about.
Yeah.
And like a lot of what I do, there are silos of things that fit. The 5.82% that I just got for the KFC, it's 1031 exchange. It ends up being a 48% loan to value. The debt service is 1.7 plus. The bank knows a 20-year brand new lease from a franchisee that has 380 units. It's a large franchisee. He's got a corporate guarantee from that franchisee. So all those things are just the bank can't lose. So sometimes, and if you're Spanish, I call them flaca deals. How skinny can you get? I'll go to the banks. Tell me how skinny you can get. You get the ideal borrower. It's 1031. The money's already put aside for the down payment. Your leverage is going to be very low. How do you win this deal? Give me the best rates and terms.
Yeah.
Now, that's not all deals. There's other deals that don't require that, but Larry's mentioning one where there's one lender that we have who lends in very finite markets, only on multifamily.
Palm Beach and Broward are two of the counties.
not Palm Beach.
Oh, I'm
He was
sorry.
saying-
Broward and Miami-Dade.
We were
Correct.
hoping
Sorry.
it was Palm Beach.
Yes, we were hoping it's Palm Beach. But you said there might be exceptions. On exceptions
they
in
can't
Palm
consider
Beach.
South Florida.
Yeah, yeah,
It's
yeah.
funny. We have another lender
Yeah.
who has an interesting program I'll discuss who won't go near Miami.
Okay.
And it's
Funny.
It's like, really, you're talking one of the most vibrant markets in the country and you won't go near Miami? Broward County barely, Palm Beach County, anything that's considered South Florida, they just got burned in South Florida on the last crisis. So their owners say, we don't want to do South Florida.
Okay.
So it's 5 1/4 rate currently. There's no windstorm required, and they don't have any lender fee at all. And it's a 30-year term, 30-year AM, but only a 5-year fix. So the first 5 years are fixed. But if you wanted to stay in that loan and have it self-liquidate, they would allow it to go 30 years.
What's their minimum loan amount?
$1 million or 6 units minimum, and up to $7 million max.
And we were talking this is, you could do it on a purchase, but it's more
Yeah,
easily done on a
They take
a
3
refi.
months plus
Yeah.
to accomplish it, and they have very interesting underwritings. They have very interesting parameters. So the 4 lenders that I have that don't require windstorm at all, as programmatically, they don't require it. Now, people ask me, will they put it in writing? They've never put it in their loan docs because they're not going to say that they don't require it because it's not one of their insurance requirements.
The language we saw in one of them was like, it was almost like you don't really have to do it, but we can ask you to do it whenever we want
I've
to.
never seen that. They don't even,
something like vague like that.
it's not even referenced in there. They say these are
Interesting.
insurance requirements, but all banks have.
They just look the other way. It's a wink, wink.
Well,
sometimes.
they've made a decision that they know their market, and the way they underwrite the borrowers is globally. So what's your global debt service coverage on all of your companies, all your properties? So if you're reporting to Uncle Sam that you're losing money all left and right, they're not going to lend to you.
Yep.
If you report to Uncle Sam that your global debt service is solid, that if you have a hiccup on one of your properties or 2 of your properties, the house of cards doesn't crumble, then they'll lend to you. So different than most lenders, look at the asset. What's the asset's debt service? Does this guy borrowed, never stole a freight train, got a good background check, everything's clean, their financials look okay, they have some reserves after closing, we're okay to go. The ones that don't require a windstorm say, okay. And annually, they look at that. And if annually you look like you're struggling, they're going to come back and do a clawback or call the loan.
One of the lessons I've learned from doing, owning these assets for a while and doing refinances at different points is you got to be careful with what you do on your tax returns, to your point, right? So
Good point.
you like R&M versus CapEx. And when these two,
Explain R&M.
repairs and maintenance,
There you go.
standard stuff that goes into
Recurring
arguably
expenses.
recurring expenses that goes into that NOI calculation. Whereas CapEx, arguably you put below the line, and most lenders, tell me if I'm right or wrong here, most lenders will be like, okay, that was a CapEx expense. You put a roof on.
Correct.
I'm not going to count that against your NOI calculation when I'm looking to issue you debt on this refi. So if there's a gray area and you take that roof or whatever and you put that in the R&M category and then you report that on your tax returns, which basically helps you have write
Less
that
taxable
off.
income,
Write that off in that exact year versus depreciated across X amount of years. the lender is going to look at that and say, well, when they look at your tax returns, that's R&M, right? And
what people do more than that is they own 4 or 5 properties and they just
move stuff around.
Whatever
and
looks better, right?
Totally.
This property had a little less income, so let me put the expenses from here or there. Or or what they do is they have a management company and they charge a 30% management fee.
Yeah.
And the property when they do their annual reporting doesn't debt service.
Yeah. Yep.
It's not uncommon they do that. Now, it depends on the lender. You want to know what their annual reporting requirements are. If their annual reporting requirements just send a P&L at the end of the year, great. If they require the filed tax return within 60 days of filing, and you send that tax return and they analyze it, and they're going to ask questions. Why did you drop below? Your property shows it's losing $12,000 even after you add back depreciation and mortgage interest.
I got a letter from a bank, I won't name the bank, that I had to sign because my DSCR that they calculated on 2 of the assets that we have 2 separate loans on were like 0.9 or whatever, or 0.75. And it's because we buy these assets and, we turn them, right? We turn them, clean them up, and get them up.
A lot of money.
And a lot of that rolls into the R&M budget,
right.
Versus maybe a CapEx number. And so they're looking at this. They were asking me, they're grilling it, and I had to give like this whole like thing, this reason why we're where we are, so we don't, because again, that's a violation of the loan terms.
Yes.
Right. And so they are cool with it. It's fine. But I had to sign stuff saying, hey, we all acknowledge that you didn't hit this target and we're not, defaulting you on the loan, but this is.
But watch out.
Yeah. But watch out.
So the commercial loan, there's 2 types of default. There's a monetary default and there's a technical default, meaning that you defaulted on one of the loan terms. Monetary default doesn't go into place until after 90 days. So you have 30 days, you're late, you're delinquent. After 60 days, you're very delinquent. And 90 days, they put you in default. On the technical defaults, there's typically cure periods built in, but you can go into default day 1 if you don't meet one of those covenants. If you materially change the asset without getting permission, if you decide to convert it to an Airbnb from an apartment building, they can catch you on that. If you ever do that, my suggestion to my clients is you have a siloed profit center called Airbnb that's an LLC that leases the units as either master lease or individual lease to those apartments at market rates, and you run that as an apartment building, and you run this as an Airbnb. And the Airbnb does profit and loss based on their Airbnb and their revenues after they pay rent and whatever expenses they pay to the units.
That's a great
idea.
comment just for people. Yeah. I bought a condo building, the whole building, all 9 units. We aggregated them all. And when we bought it and did the loan, we were converting from condo to multifamily. And so I had to have an upfront discussion with that lender saying, hey, here's the business plan. Yeah. Like you say,
like collapse the condo at a certain point.
We can do all this stuff. And they were just like tracking and watching and following up, like, hey, where are we at in this process? And, and it took almost 2 years to fully collapse it. And we had to give them like the final, hey, now we're a multifamily building. Okay, we met the terms of the agreement, and they lent based on that was in some of their documentation that we will be converting this to multi because they don't lend on individual condos.
And if you're buying something that's currently operating as an Airbnb or you want to convert it to an Airbnb, I've done plenty of those. It's a different type of functioning. So you may try to provide underwriting as what you're going to make as an Airbnb. Just letting you know, hospitality, let's say in this market, an apartment building may operate, market cap rate is about a 6 cap, maybe 6.5 cap, whatever it may be. But if you're buying a hospitality, it's going to be a 10 or 11 cap. So if you try to show an apartment lender what your revenues are going to be as hospitality, it's not going to work. What I need to do is underwrite it as an apartment building, if it's an apartment building or can operate as an apartment building, even though you can legally operate as an Airbnb. If you have a hospitality license, most lenders cap at 65% leverage on hospitality. If you don't have a hospitality license but are going to operate as an Airbnb and in that municipality you're able to do that, we have to underwrite it as an apartment building. But what I make sure happens is, in South Florida specifically, a lot of them are close to the beach. If it's on the east side of the intercoastal, I don't let the appraiser use any comps from west of the intercoastal. Because I say, if you got to get in your car because you forgot your suntan lotion, or you need to go use the restroom, or you want to go get some food or whatever, it's not a comp. Because you could just walk back to there as an Airbnb that has a lot more value, but as an apartment it has a lot more value. I said only comps that can be is on that strip. And I've worked with Daniel on that, where he got me comps of individually owned condos that rented that are on that strip. Because there are
Seasonal
very
rentals,
few
yeah.
apartment buildings that function as apartment buildings on that strip, so you can't get comps. But don't use a comp from a mile inland and call it comparable to an Airbnb or an apartment rental in that strip. So part of my job, appraisals are independent. They're bid out independently, so it's blind. We get back A, B, C, D, and it says a price and when the report's due. I have no idea who the appraisers are. They're chosen blindly. And then my job is to show them why these numbers are accurate. Typically on a purchase, very, very few come in under the purchase price. It's an arm length transaction. It's been negotiated in public and the market spoke. Refis, people may have an inflated value of their property, but my job is to provide all of the leveraging my real estate sales partners on their information and their knowledge, leveraging CoStar and other resources to make sure, and then driving the market. So when I'm there physically at the appraisal, and I attend probably 95% of my appraisals, to make sure the appraiser's seeing what needs to be seen, and also to make sure when the bank gets the report that I know what's going to be in that report, meaning eyeball-wise, like you're going to see some areas, but the borrower is going to fix this. Or it's in the contract, the seller's giving them credit towards that, and we'll escrow that money in order to fix it, whatever it may be, to make sure the deal works. But again, the sales broker looks at getting under listing, getting under contract, and then I'll see you at closing once it clears contingencies. My job is from the time loan starts until it closes, I'm working every day. My team's working every day because things can pop up. Right now, it's the municipalities leaning properties. I'm not sure if you suffered this.
Oh, yeah.
3 deals supposed to close last year. One was a landscaping, one was a fence enclosure, and one was the I forget the 3 liens. And they give the notice to the seller. The seller's like, "Oh, I'm selling the property anyhow," and they don't address it. And now it's accruing every day. And because that penalty, if it has a finite, it's easier to escrow for.
Absolutely.
If it's accruing, how do you escrow a number that's keep growing every day? So it could slow the deal down or it could kill it because we can't get clear title.
Yeah. Yeah. We're often able to escrow money and then allow the deal to close as long as the lender will do it. There are times that sometimes the lender's not even always aware of some of these issues because they don't. If it doesn't show up as a lien, sometimes it's just a code violation and it's on the lien search.
It's on its way to a lien.
It's on its way, but it's not at a lien stage. Then the lender doesn't always have to know, and they don't always have to get involved in it. But we're often able to escrow monies for that. But like you said, if it's an ongoing fine and it's not closed out yet, we can't close as the title, as the law firm handling that. So
some of them
it's got to be closed out. Then we know what the penalty is, and maybe we'll escrow or hold 1.5x, for example, of the penalty. So maybe it's a $30,000 penalty. We'll ask for $45,000 in escrow and give the seller, 90, 120 days to close that out, and also to try to mitigate the fine to get it down to a very small amount. Yeah,
and that's why my team works with Jerron's team hand in glove, because that pops up. I've got to let the lender know how we can address this. But if he doesn't catch it, and then the buyer is now dealing with this thing that he doesn't even know about, and the municipality is coming after them for something, or they cause sometimes when it comes up, like this one we have a landscaping, the person in the landscaping had no idea they did it wrong. They didn't get permission to do the landscaping. They thought they were just putting trees in. They had to tear out the trees. Then they had to get permission to get their plan together for the new landscaping, get that approved.
Yeah.
So it had to go to
that can take a lot of time.
The city commission has to approve all requests, and they had to. But the city commission got canceled because of the holiday season, so they canceled their meeting. That's why I rolled over from last month. Yeah, and this was a sale.
Yeah,
and the selling agent, nobody was happy. Now, if this was 1031, we could have had some problems.
Yeah, could have big problems.
The government doesn't care about that.
Your deadlines are your deadlines.
Drop dead date.
Yeah.
So, but that's why part of what we talk about with our clients frequently is the team around you. It's your agent that's representing you on the buy side, your attorney that's representing you, and us work together to get this closed. And it doesn't just happen. Again, things pop up, and there may be a thing where they have to actually, we've had this, they have to reopen a permit that was opened but never closed, and the work was never done, so the person wasn't going to do it anyhow, but reopen it, and then not do the work, but get it closed with inspection of the work not being done to show, because it wasn't required work they were doing, but somebody opened a permit but never closed it. So it's showing open permit that was never inspected. So what happened? Did they do it illegally? So they had to reopen it to get an inspector out there to show the work was never done in order to reclose it. Sounds crazy, but it's the government. And if they require it, how do you get the deal closed? You got to get it closed.
Follow the rules.
We deal with that all the time in the resi world.
Yeah, we do.
People just don't know that they didn't get something closed out or something's off or whatever, right? Or it's from 30 years ago. And then-
Open
Dealing with
permits
it
is
as
a big issue.
layperson,
Yeah.
You're like,
Yeah, they're
and you have your day job and you're doing other things. You have to deal with this issue.
Yeah.
That's why you hire us, because that's all we do every day. My team closes, our goal is to close a loan a week. We close on average over the last 10 years together, we've closed about 60 to 70 loans a year.
Awesome.
So
amazing.
That's very good volume in the commercial world. Yeah.
And what that gives you as a borrower is you don't go to Joe Bank or the bank that you're at and say, can you do this deal for me, or try to find a bank. We go to the people that we do a dozen deals with. So one, they know we're not throwing it against the wall. We know it's a deal that they can do. Secondly, I'm telling them all the things they need to know that help the deal versus them discovering things so they know they're getting the straight poop. So when I was a lender, I used to have to go back into my committees and talk to the underwriters and get in front of the committee and vouch for the deal and be the advocate for the deal and to get it done. I can't be in that room, and you can't be in that room, and the buyer can't be in that room. It's that loan officer. And if I don't give them enough color to accentuate the black and white that the committee sees, the deal may die in committee. I had one deal die just because the bank president happened to be in town from Puerto Rico, happened to be in town at the bank. Even though it was Small Bay Warehouse, the name of the deal was Boca Storage. They just lost 2 deals. They got burned on 2 deals that were self-storage deals. And he said, we're not doing any storage. I said, no, this is Small Bay Warehouse. I don't care. It's called storage. And they dropped the deal at committee.
So arbitrary.
Some of those things are. And have to scramble. But my job is to have the backup and know where else I can place this. I call up, say, I've got a full package, appraisal in place. It's from a national appraisal. It's done through for a bank, et cetera. Can you do it? Great. We can close it in 15 to 20 days because we already have title work. Just have to change some certifications, get things. But you have to sometimes move on the fly.
Yeah. You have to call audibles. It's the name of the game in this business for all of us. Yeah.
Well, that's awesome. I know we all have a a hard stop here. So any other questions you have?
No,
Anything else
great.
you want to talk about?
How can people get a hold of you? We'll put your website address there under the video, but anything you want to throw out there?
With my name, David Purisch, if it's on there,
Sure.
It's uniquely spelled. So if you type it correctly,
Easy to
you'll
Google and
me at
find you.
Beth Tremblay. Yeah, it's
Right.
not John
Awesome.
Smith where you have to search for the right one. On LinkedIn as well.
Good.
And I encourage you, if you have questions on debt, just give me a call. We'll have a conversation. At least you'll go into this with having some knowledge of what's going on and what the next steps may be. If you decide to use our firm to get the deal done, we'd love to help you. And that's always I ask, how can I be of assistance?
It's great.
If I can help you get some more knowledge, great. If I can help get the deal done, even better.
Awesome. Well, thanks, man.
Great.
Thank you,
Appreciate
David.
it.
Thanks for
Thank you
being
your
here.
time.
Yeah.
Thank you for tuning into Real Deal Investing. If you enjoyed the episode, please like and subscribe. We'll see you guys on the next video.